Hello, everyone. I'm Boots Dunlap, CEO of RE Capital. For those that don't know RE Capital, we're a private credit fund focused on commercial real estate bridge lending in the lower middle market. This is our first webinar that we've done, and we felt that given the times that we were in with historic rate acceleration, a banking crisis, and the transformation of commercial real estate, particularly with work from home, that we felt it was very important to communicate with our clients about what is going on in the market in an honest and transparent way. We feel the best way to do this is not with bias or impartial feedback, but finding an honest referee of the commercial real estate market that's really focused on reporting data and not a narrative. And there's no better steward of impartial data, in my opinion, than CoStar. CoStar is the world's largest data provider of commercial real estate, and they really have no incentive to state that the market is stronger than it is or that it's not as strong. They really are focused on calling strikes and balls and projecting the most accurate view of the market as it stands today. So with that, I was able to get someone that we're very lucky to have with us, but it is Chad Littell. And I'll be introducing him. You can't see him, unfortunately, because his camera's not working. However, he is dressed in a coat and tie, so he's assured me. But we're really lucky to have him. So recently, CoStar has put a national director over the head of each data set. And one of the data sets that they've been getting, obviously they're the largest commercial real estate, that they've been getting better and better on is capital markets. And so Chad is actually the very first national director of capital markets. This is a new position for him. I would say he's a very interesting choice because he's not an economist, he's not an appraiser, he's not a data scientist, but he's a real world practitioner of real estate. And my hat's off to CoStar for doing this. CoStar has, and he will tell you on his team, he has tons of economists, tons of appraisers, tons of data scientists. But it's one thing to be able to report the data, it's another to be able to interpret the data. And so given his experience as an investment sales broker for over 20 years, most of that time was with Cushman & Wakefield, arguably one of the best brokerage firms in the US and possibly even the world. He spent a lot of time looking at capital flows on the equity side. I mean, he also worked nationally covering leasing in office, industrial, flex, but a big part of what he did too is really tracking capital flows and what was going on in the market, both anecdotally and then from the data side. And I first met Chad during the Great Financial Crisis. Shortly thereafter, Chad worked with Chris Tosi, who in my opinion is one of the most scientific brokers in the commercial real estate space. Early on during the Great Financial Crisis, people were trying to figure out, and this was long before CoStar really had the data sets and the, I'd say that they really were at the level that they are in terms of data. Most of the data came from brokerage houses, and so Cushman & Wakefield was very good. And then Chris Tosi was exceptionally good. And Chad worked on his team, and I remember seeing back in 2009 or 10, Chris gave a talk on the market. And one of the things he said is, you've really got to stay away from narratives and you've got to look at the data. And he mentioned something that I'll never forget. He said, I'm a pilot. And sometimes when you're in the clouds and you don't know which way you're going, it's really difficult to orient yourself. And so you need to be looking at the dashboards and the instruments and say, what are the instruments telling me? And Chad is a guy that stares at the instruments all day, and he's also a guy that has the real world practical knowledge as a 20-year investment sales broker. I should also mention too, while we are a debt shop, Chad is focused most heavily on the equity side. That's a lot of his experience. So any questions around debt, he may be less positioned, less inclined to be able to respond to, and we can certainly handle the debt questions. But with that, I'd like to turn it over to Chad, who, as I mentioned, if you couldn't hear me before, you cannot see him. He's having some temporary issues with his camera, but nonetheless, he's got a phenomenal presentation. and most importantly, you'll be able to hear from him. So Chad, if you're on, I'll pass it over to you.
I am on, and thank you, Boots, for that great introduction. And just to springboard on what you were saying, Boots, is where I've got really a passion in terms of looking at the data was in my chair as an investment broker, and going through and coming out of the Great Recession, being in a kind of a boom bust market like Phoenix at the time, and just really it was all about selling Phoenix and selling data and selling Arizona, and it was a couple of years of selling macroeconomics before investors really wanted to start to dig down at the property level. And so that's what going back 12 years ago is what kind of ignited in me a passion about understanding why and what is the data telling us, and what do market practitioners actually do with that. And so that's why I left brokerage to be here with you today, representing CoStar to go through this presentation on capital markets. So with that, we're going to dive right in here. And our roadmap here for the next little bit is kind of in 6 segments. And so it's all in terms of capital markets, it's all got to start with interest rates. I mean, we've essentially seen the fastest rate hiking cycle that many of us have seen in our careers, and it's kind of locked up market that's created a bid-ask spread, and that's starting to flow to pricing as we see transaction volume kind of stall across the board. We had kind of record-setting years in 2021, and that's kind of made a dramatic shift. But there's a lot of money that's out there that does want to participate in buying new assets, but really we're kind of down to a math equation and how interest rates have impacted underwriting. And then we're going to look at liquidity from a lender standpoint and what's going on in that space with some of the turbulence over the last couple of months. And then finally, we're going to touch on delinquencies and some of the movement in that space. And really, I would say as it's probably a positive note at this point, just kind of as a early look on that one. Just we're coming from really historically low levels for delinquencies, and so that is some comfort I think I'll leave you with towards the end of the presentation. But so as we dive in and we look at interest rates, to set this up, what you're seeing here is the last 7 hiking cycles compared to one another. And so you can see across the bottom there, that's time and months of duration of hiking. And then on the left, the vertical axis, you see the percentage points that the Fed increased. And so what should jump right out to you is in 2022 in the blue on the left, you can see that's by far not only the highest, but the fastest rate hiking cycle. And so if you average all these 7, the Fed increased by 3.4 percentage points over 22 months. So we'll call it 3.5 percentage points over 2 years. What the Fed just did is they went 4.83 in about a year. So they hiked 40% higher in half the time. And so if you think about comparing that to, say, the purple line in 2015, if you are driving down the freeway at a set pace and you accelerate and go 40% faster over half the distance, you're going to feel that much more rapidly than what we felt in 2015. And so clearly the Fed is on a warpath to get rates up and to deal with inflation. And so that leads us to our next look is, why are they doing this? And so to set the context on this slide, the green represents inflation going back to 1954. The black line is the federal funds policy rate. And a couple things you should notice right out of the gate is they track very well together in terms of the Fed's response to what inflation is doing. As you see the gray circles, those are the points for which the Fed was in hiking stages, and they generally hike until the black line meets the green line, which is inflation, and they try to hold it generally as long as they can. And so there's one exception to that, and I think that's what the Fed has in front of them now, and that they're concerned about is if you go back to 1974 and you see inflation ran up to 12%, Fed hiked rates very quickly. Inflation came down and they thought the war was over, they won. Inflation hit 5%, but then reversed course, and actually the problem got worse. It hit 14% a couple of years later. And so with the situation we face now, if the Fed was to stop and reverse course quickly, it probably would ignite something very similar to this. And so some of the Fed talk that you've heard recently is their goal is to hike probably a couple of more times and then hold it for as long as they can. And one of the things that they're watching that's not on this chart is really core CPI. And so we saw the headline print come from 6 to 5 just over the last month, but core CPI actually went up. And so that's basically, it's CPI X energy and food. And so that's probably one that they're watching more. And so the expectation of the market as of today, there's about an 89% chance that they hike by 25 basis points. And so that's the expectation, is that they're going to hike probably one or two more times and hold as long as they can. And so one of the things we won't find out for some time is what the implications of that are. We're already starting to see back on back 75 basis point hikes, which occurred last year. But one thing to keep in mind is the effects of rate hikes like this generally take quarters and even sometimes a year or more before you see it fully flow through the economy. And so this presentation is going to be interactive. And so we've got 4 poll questions that we're going to introduce to the group today. And so this is going to mark one of them. And so the poll question we have right now is about interest rates, and we're going to ask you a question here. And if you could take a moment to answer that. We'd love to get some feedback from the group on where you think this is going to go.
I'd like to use this moment to mention there's a chat feature, and there's also questions. So feel free, if you have questions, we'll be doing some Q&A afterwards, to put them in the question bar or to chat.
Let's give a couple more seconds there. Looks like just about everyone has answered, and so hopefully you can all see. We just confirm you can all see there the results of that. About half the group thinks that they'll stay about the same, and I would say I'm probably I'm in the camp where I think we go higher. We've had a couple of Fed officials come out just recently saying they think it's going to be 25 to 50 basis points higher over the next couple of months, but that's probably where the terminal rate will ultimately be. And so that's great feedback there. Okay, so we'll move back on and get back into the presentation. And so again, as we're thinking about rates, the Fed has moved rates incredibly quickly, and so what that's done to the market for borrowers out there looking for debt, as you can see, this is basically looking at the major property types by various lenders. And so this is data from Slat Capital, coming on Middle Markets mortgage broker, who's publishes all the data, and over a 60-day period, they go out and they aggregate all of the different loan quotes they've got across the country, across lenders, across property types, and they show what the lowest rate that was quoted for that lender on that property type. And so on the left, you can see March of 22, you can see generally rates are in the low 3s for agency debt and multifamily, sub 3%, but generally you're looking at low 3s. And then March of this year, again, these are the low quotes. So many of these quotes are going to be higher than this, but we essentially went from the low 3s to mid 5s across the board. And so that's having obviously substantial implications to overall or all-in borrowing costs, and it's impacting cap rates as well. And so as we think about interest rates are going up while cap rates continue to stay flat or even compressing for the higher end of products, we're basically seeing a compression that we haven't seen since 2009. And so as you look at this graphic, think about each of these horizontal bars is almost like a piston, where the light equals the total distance there of hotel, for example, 442 basis points. That's the long-term spread over investment grade bonds for that asset type. And then in the darker color, think about that like a piston oscillating left and right as cap rate spreads over triple Bs either compress or expand. And so across the board, we are way below our historical spread over triple Bs. And you can see even for multifamily, that's just at a couple of basis points. And so as we're seeing pricing start to adjust, these spreads are going to open back up, and we anticipate seeing cap rates move higher. We know that at a transaction level that's already occurring, but it just takes time because we are seeing lower transaction volume. It takes time for that data to flow through to the publicized information. And so if we look at what public equity REIT implied yields are telling us, you can see that they've moved up across the board. And so what we're not saying is this is exactly where the cap rates are going per property type. This is taken directly from the public equity REITs. And so as rates are coming up, we're starting to see rents soften in many places, and so the underwriting is not conducive to underwriting supercharged rent growth like we've seen over the last couple of years. And so now there's a growing attention in terms of your going in yields, and so that's why these are lifting. And so one point to call out is your starting point really matters. And so for industrial and multifamily, starting at the 3s and 4s, if you increase those by 150 or 200 basis points, that has a substantially greater impact on property value than if, say, you're in the 5s, 6s, or almost 8 in the hospitality sector. That same basis point increase doesn't have the same property level price impact. And so if you were to take these at face value, that would be north of 20% value declines in industrial and multifamily. Again, the smaller move in retail is showing kind of low double digits. Again, north of 20% for office, low double digits for hospitality. And so we're starting to see pricing adjustments occurring because of this lift in cap rates. And so what this is taking into consideration is the CoStar Composite Resale Index. And so it basically takes a pair of trades, the same asset, when it trades 2 different times, and it looks like the price adjustment for each of those trades. And so one thing to call out is if you're focused on a specific property type, as we go through this presentation, the coloring is hopefully going to match throughout. So green in multifamily, yellow for industrial, et cetera. And so this is broken out by quadrant. And if you look at where each of these assets has performed, multifamily has been the outperformer across regions, with industrial trailing close behind. One thing that's interesting to note is that in the last cycle, you can see this pairing up really of multifamily was the outperformer last time as well, but it was really retail that was coupled up with multifamily that was doing well. And then if you focus like on the Midwest, for example, you can see the red line in retail versus the yellow line industrial. Those kind of crossed paths right as COVID hit, where there was kind of a negative view on retail, which actually began a little while before COVID, and you see this big push in industrial. Same would be true for the West and the South as well. And so it's really interesting to see the price appreciation and then which assets have done well. And it's one area to call out is what we're seeing in the Midwest currently is just more of a steady flow of transaction volume. We're seeing nationally, we're seeing property level fundamentals, market level fundamentals decelerate, but I would say they're decelerating at a slower pace in markets like the Midwest. So said in another way, the markets that we've seen boom the most over the last couple of years are showing kind of the greatest declines in transaction volume and fundamentals going forward, while the markets that were somewhat the quietest over the last couple of years, they're just kind of marching along and kind of slow and steady. And so if we look at it from again, property asset type level across the country, this is, at a quarterly level, you're looking at year-over-year change in property price appreciation. So you can clearly see on the left, industrial and multifamily were the big winners. Industrial is still considered, the safest place or one of the safest places to allocate capital today. There's still relatively strong demand in most markets historically. And then you can see multifamily in green, highly rate sensitive. That was one of the first markets or product types to correct and to start to show kind of declining year-over-year price appreciation. Hotel in the middle, kind of don't focus too much on those last couple of quarters that are showing big pops. That's really the base effects that coming into the throes of COVID, hotel values were hit so hard that they're basically just falling less at the moment. And so it's really the luxury market in that space that continues to do very well. Again, retail is something I'll keep pointing out is doing well. It's faced a lot of scrutiny pre-COVID, during COVID. It's held up very well. A lot of that market is private capital. We're seeing all-time kind of low vacancy rates with very little supply coming down the pipeline, and just favorable lease structures, triple net leases with generally good term, good visibility into who those tenants are. And so we're seeing less of a decline in the retail space. And then office is just kind of the large unknown. There's some significant headwinds in that space. So as we think about transaction volume as a result of these price declines, one of the trends I wanted to call out is that if you go back historically and just focus on 2016 for a few minutes or a few seconds here, you can see this lift in first quarter through fourth quarter transaction volume. So the highest quarter transaction volumes highlighted in each of those years. And so you think about the sales cycle, the seasonality of putting properties on the market during the summer, those prove up good comps, right? And so if any owners want to take advantage of that or close by year end, for fund or tax reasons, they're going to try to get that done in the fourth quarter. And so we see this cookie cutter replication from 2016 to 2019. Despite second quarter of 2020, it still held the same. And then you can see this just enormous boom in liquidity, really, that we've never seen before. And really the apex of that was in Q4 of 21. And so 22 is something that we haven't seen in the last, call it 10 years. And so the second quarter was the highest, and we've started to see that trail off. And the last time we saw that was in 2007 in terms of this trend of kind of trailing off. And then 2008 saw further declines in transaction volume. And so one thing I will point out is if you just compare this 2022, despite falling transaction volume, if you just kind of take Q4 and scan across to the left, you can still see that Q4 2022 historically was an incredibly active quarter from just overall transaction volume, but we're comparing it to kind of the all-time high in Q4 of 2021. And so this is kind of breaking those two time periods down. And so by asset class, what this is showing, if you focus on multifamily, the left column is transaction volume in billions as of first quarter 22. The right column is first quarter transaction volume of this year we just came out of. And the middle column is the 5-year average before we went into COVID. So from 2015 to 2019, the 5-year average of Q1 performance. And so a lot of the headlines that you're seeing is this massive year-over-year decline in transaction volume, but to keep it into perspective, we're comparing the all-time high versus a relatively very strong quarter. What I think is more instructive is to look at the middle column versus the right column. And so we clearly saw a decline in multifamily, but industrial is actually up, continuing to be the favorite asset class. Again, retail is kind of moving sideways. We know about the issues that the office sector faces, and then kind of hotels kind of largely moving sideways. So it's less pronounced when you look at it on a historical basis. And so that transaction volume is telling us there's a lot of capital that's out there and wants to participate. But as rents are decelerating in certain markets, some of this capital is kind of in a waiting mode, which is pulling transaction volume down. And so if you see the composition of dry powder, and so this is capital that's committed but not yet called, you can see it's largely value add and opportunistic capital, and you can see the growth of that on the right side. And so this capital is ready to go, but without being able to underwrite through strong economic backdrop and supercharged rent growth. Again, you've got to take going in yields, more concentration there, and then just getting more into kind of the submarket level, asset level, but there is value add capital that once we continue to see this pricing adjustment, once it hits a pricing standpoint where this capital feels like it's ready to return, we'll see transaction volume pick up in a big way. And so we've looked there at capital that was called but not committed, and this is just looking now as we kind of pivot the discussion around liquidity, and we think about what about new fundraising going forward. And so for funds that are out over the last couple of years looking to close new funds, it's essentially the time period in months has essentially doubled. In 2019, it was about 14 months to complete your fundraising process, and while today, as of second quarter of 23, it's about 28 months. And so to continue the theme with just kind of looking at liquidity, this is focusing on banking deposits. So this is all FDIC insured institutions. And so I know you're all aware of some of the banking challenges that we saw, in February and March. Specifically Silicon Valley Bank was in the news as much as anybody. And one of the things I want to point out is that didn't just spring out of nowhere. It didn't happen right in January, February that there were no signs to see that something could be going on. If you look at this chart, you can see massive outflows of deposits that occurred in the second quarter of 2022. And I don't think it's a coincidence that while that was occurring, that's right at the time when the Fed started hiking rates, as well as they started reducing their balance sheet, that we start to see these deposits come down. At the same time, you started to see corporates that need funds to operate their business, that the debt markets started to get more challenging. So they start drawing down on their liquidity to fund their operations. And then at the household level, inflation has been posing a lot of challenges for a big portion of our population. So they're drawing down on those funds just to live. And so this was an issue that started in concert with the Fed tightening its belt, and it manifested in February and March. And I don't think that was a little blip. I don't know. I'm not saying that we're going to see lots of repeats of the SVP and Signature Bank, but the problem I don't think was necessarily solved. And as we look at this next chart, this is a dynamic that essentially was created by the Fed. And what we're seeing here is unrealized losses on investment securities by US banks. And you can see that drawdown is larger than anything we've seen in this last cycle. And so if you think about the last 3 years, the Fed, as we went through the COVID era, how much money was sent to households, to PPP, student loan forgiveness, et cetera, that created a lot more cash on hand. And so they put that cash in the bank. And so these banks took those excess deposits and they either lent them out or they bought other investment instruments with generally longer dated time horizons. And so deposits grew faster than the loan growth. And so as they bought investments with very low interest rates, and then the Fed hiked interest rates, as we just saw, you can see what the unrealized in this case loss is on those assets. And so the Fed balance sheet would also look similar to something like this, is that they own a lot of these assets, right? And so they've got flexibility of how long they hold it and what they do. But essentially what we saw, I don't think, was a hiccup in the banking sector. It's a problem that will continue to persist. And so what this is partly doing is it's translating to bank lenders tightening their belts. And so when you see this kind of longer term time horizon, you can see these tightening standards, when they get to these levels, are typically at recessionary levels. And so when you've got a tailwind of, or excuse me, not a tailwind, you've got the kind of three things going on of higher interest rates in an inflationary environment, and then when you see lenders tightening into that situation, that is typically an environment that is kind of at the beginnings of a downturn, recession, or just before that occurs. And so as we keep focusing on the lending market, there's been a lot of talk about what is the actual composition of the lenders and who's holding this commercial real estate debt. And so the universe that you want to think about for commercial real estate debt is about 4.5 trillion. And this is the breakout in terms of the different lender types. And so you can see banks hold about 1.7 trillion of that. Non-banks hold 2.8 trillion. So really banks are your primary lender at 38%. The GSEs with Freddie and Fannie, that's about 1 trillion, heavily concentrated in the multifamily space. CMBS gets quoted a lot because the data is readily available. It's very accurate, it's real time, it's updated, but you can see it's a very small percentage of this market at 17%. And then your life cos make up an even smaller portion. They're very conservative by nature. And then where you see either other or investor driven on these slides, that's really your debt funds, your mortgage REITs, et cetera. But really, we covered a lot of banking stuff leading up to this because, as you can see, banks are about 40% of your lending market. So as we think about the maturities that are coming before us, again, 4.5 trillion in outstanding debt. Over 23 and 24, we've got 1.4 trillion of maturities approaching. That's almost a third of all outstanding debt that's coming before us. And so that's highlighted in the blue for you on the left. And then we're going to look here at maturities by property type. And again, going with the theme of kind of the blue for the first couple of years, you can see office and hotel kind of have the larger concentration of those near-term maturities. And so what this is saying is in 2023 in the dark blue, office has about 25% of total office maturities are coming due. And then in 2024, 16%. So a total of about 41% in the office space, 54% in the hotel space. You can see multifamily and retail, much lower percentage of that. And then you can see on the right, in terms of the lender types, how much investor-driven debt, for example, is maturing over the next couple of years. And so you can see, 26% this year, 26% next year. The banks have just over 40%, and then CMBS would be a little bit less than that. One of the things you can see that clearly stands out in opposition to that is that GSEs have very little maturities coming due in the next couple of years. And so as we're talking about different product types, we're going to actually introduce another poll question for you and take a breather from the slides. And so as we think about different product types as these loans mature, what do you think which asset type do you think will show the strongest rent growth?
Loving the bold person that said office.
Absolutely. It's also interesting. So I can share this with the group. So clearly industrial, yes, and that's definitely evidenced by the transaction volume that we talked about earlier. Q1 of this year actually showing higher transaction volume than the 5-year average, and multifamily and industrial continue to outperform. What's interesting is, in the hospitality space, we're continuing to see incredibly strong rent growth in the luxury segment. With ADRs expected to grow by 10% or more in that space as well. So it's great feedback. Okay, so we're still in the theme of the lending environment, and so focusing on kind of the CMBS space next. This is looking nationally at just the concentration of CMBS loans under scrutiny. And so the darker the red would be a higher concentration, kind of the pink would be middle, and then gray would be the lowest concentration. And so this is a combination of all CMBS loans that are either delinquent, in special servicing, or are on the watch list. And to clarify, the majority of this, which is creating this depth of color, is the watch list, to be clear. So we'll see in a bit in terms of looking at some of the delinquencies. But of these watch lists, that could be things triggered like a large tenant with a lease maturity that's coming up, or if there's a kind of a slide in some of the debt service coverage ratios, or that's starting to fall below some threshold. So doesn't mean that watch list will become delinquent, but really this is the entire universe of the CMBS market that's being watched. And when we think about it on a property type level, you can see that the concentration of that is in the office space, 34 billion, and in the hospitality space. And so those are also, as a reminder, the two segments that have the most maturing loans in 23 and 24. The retail space, you can see a lot of the retail space is very healthy with incredibly low vacancy rates. Strong demand remains. A lot of that is coming from kind of obsolescent retail, class B and C malls and so forth. And so that's really probably the three key areas, to focus on as you think about loan maturities coming on over the next couple of years. You can see multifamily as most of that funding comes from the agencies, and industrials incredibly low. So as we look at the CMBS, and this will actually be the last slide, and then we've got one more poll for you before we turn it over to questions and discussion. But as we think about CMBS delinquencies, we've not even included multifamily on here. It's not a big portion of this type of debt, and delinquencies are virtually non-existent. But if we start from industrial on the bottom right and move around clockwise, you can see industrial there is at less than 1%, incredibly low. If we move to office, that's probably the one area that's shown a pronounced pickup in 30-day delinquent loans, and you can see that the delinquency rate went from about 1.5% to 3%. So although it's coming from a low level, it did double, and Fitch Ratings is expecting that ultimately to get back up to its 2020 high of closer to 6%. You can see retail really kind of moving sideways and doing nothing. And then on the hospitality front, that moving down and touching about 5%. And so I will call out one area as the newest amount of data is being released in the month of April. Hospitality did show a meaningful uptick in delinquencies, and I decided not to include it just because there can be some gyrations in data as you collect it over time that could settle down. But it definitely picked up a yellow flag for me to start watching that segment a lot closer with these CMBS delinquencies. So overall, Fitch Ratings is anticipating the CMBS universe to get the collective delinquencies up to 4 to 4.5% by year end. And so the last point I'll kind of leave you with is, as we're seeing a wall of maturities, we're seeing falling pricing and falling demand. I would say the part to consider is that if you want to look over to 2018, for example, where these delinquency rates were pre-COVID, we're starting from incredibly low levels. So that's one area to view as a positive. And so in terms of the slides, that's the last bit of information, but we're going to do one more poll before we turn it over to Boots to do some Q&A. So it looks like the results, it's concentrated around high interest rates. It's kind of the biggest concern for the group going forward.
Well, Chad, thank you so much for that. I appreciate that. It's very informative, and I like hearing it coming from a data provider as opposed to a lender or even a broker sometimes that wants to, like you said, pump a certain market. Just let everyone know we do have a chat. Feel free to chat in there. And we also have a question box. And I'd love to use this time to allow the audience to ask questions of you, Chad. The audience, some of them have responded earlier with some questions, which I'll read to you, and I'd love to get responses on. The first one is, with banks tightening up and a general slowdown in lending, what asset class will be most affected? I'd love to get your thoughts on that.
So, you know, as bankers kind of move, or bank lenders, typically move, in groups and kind of a herd mentality, and they want to, they're conservative by nature, and so, what they're trying to avoid is where there's the highest degree of kind of uncertainty, or visibility of future cash flows. And so clearly the office space is the most challenging in that regard. And one of the reasons behind that is, we're seeing, not only slowing demand, but there's this growing amount of sublease space nationally, that we really don't know what's going to happen as those expire and what vacancies are going to ultimately do. Vacancies in that space nationally are about 13%, and that's on par with where we peaked out in the last cycle. And so if you think about going into a economic uncertainty or recession, as I think we're going into or already in, we're basically starting where we peaked out in 2018. And so vacancy rates are going to continue to climb in that space, and kind of the uncertainty of that specific product type is the most challenging. But what I'm also hearing on the other end is that there is capital, and lenders are wanting to, put out debt on industrial and multifamily because they continue to show strong rent growth and demand.
Yeah, I'll say just anecdotally from our team, we've seen an increase just over the last quarter in finance requests for hospitality, as well as assisted living, memory care. And one of our thoughts on that is just generally speaking, those commercial real estate asset types operate a lot more like businesses, particularly, a full service hotel in a central business district. And banks are a lot less willing to do those types of deals. And historically, CMBS has been really big in hospitality, and they have been able to really execute tight pricing and provide certainty of close, particularly at proposed terms with a lot of hospitality borrowers. And so, anecdotally, those operation-heavy commercial real estate classes seem to be sort of negatively impacted. So that's just from our perspective. Another question that we had, Chad, was around financing for distressed office buildings. Some of our guests asked if there was finance available, and what categories of lenders are the best for this. Chad and I spoke about this question in advance, and he did say, our job really isn't to track specific lenders on product types, to track more of the lender types as opposed to the specific lender. But I can answer from our team, office banks and CMBS and insurance companies just aren't doing office right now. So if there's an office, particularly a distressed office, I mean, that's a product type that's going to be done by private debt market, debt funds, possibly like RRA. I know we don't really have a desire to do office right now. And I think that was probably borne out, Chad, on your slide that you had, where it showed, I think from Select Capital, the range of, the tight quotes from, today versus a year ago, and how there was some expansion in sort of interest rates. And most notably on that slide, if you go back to that slide, Chad, I believe it was office and private debt funds had sort of the highest increase in that. So while they are the most expensive for that asset class, it's also because they're the only ones probably quoting it right now. Do you have any other feedback on that, Chad?
No, I would say again, yeah, it's not, going lender type by lender type is not an area I've got expertise on, historically with my background or something that I'm doing on a day-to-day basis. So yeah, nothing to add specifically there, Boots.
Great. Another one, which I think you have, just talking to you, I know you've got a great answer for this, but one person asked, are there specific geographic locations that you are more worried about or excited about than others? How would you answer that?
It's a great question. And as I think about geography and, we looked at, I'm going to pull up actually one of the slides that we did look at. Here, you can see that it's not been kind of an equal pace of growth. You can see that on the west and in the south, you can see specifically multifamily has had a much bigger run up in values, and you can see this coupling of industrial and multifamily going up, while generally retail and office have lagged. And as I think about what's underway currently in some of these markets that boomed over the last couple of years, is they have record supply deliveries coming underway. And so there are markets throughout the west and the south that saw some of the strongest rent growth and price growth that are now, they're going to see supply deliveries that they've never seen before. And so that's coming in the face of slowing demand and actually slowing rental rate growth. And in some of those markets, they're actually seeing outright negative rent growth. So as I think about geographies and the people on this call, I think the particular attention needs to be paid to not only today is what's the fundamentals of rents. Are they flat? Are they decelerating? Are they growing? Vacancy rates? But when all this new supply hits, what will that do in the face of slowing demand? And one of the things that I don't have numbers to quote you, but as I go throughout kind of looking across national trends in the Midwest, I continue to see as the nation decelerates almost across the board fundamentally, the Midwest did not see this big boom over the last couple of years like some of our other regions did. And so we're seeing transaction volumes in some of those markets actually the same or higher than they were in 2021. And we're seeing kind of leadership change in terms of rent growth and so forth. So I think you can't just necessarily look and say I'm going to invest in one asset type across the country as a theme. It's like, I think you've got to get very targeted market by market of what is this supply going to do to that market as they take on new product like they've never seen before. So that's how I would answer that. And I would say that I don't think there's any one asset class you have to totally stay away from. I think if you're going market by market, sub-market by sub-market, you're going to be able to find places to allocate capital across product types. And so, retail is a very interesting place because it's already kind of gone through some challenges pre-COVID, and something like hospitality and in that luxury space is probably going to continue to do very well because of the luxury consumer. But business class hotels along with office will probably struggle. So I would say in answering that question, it's got to be very targeted versus kind of a broad, investing kind of theme.
Yeah, I know, just kind of add some color. I think it's really easy to try to be a thematic real estate investor where you're going to pick geography in a product type, like blindly, or follow a headline that you read in the Wall Street Journal. But it really is within every product type in geography. It's submarket to submarket, asset to asset. And you can find great deals and horrible deals in those that have the biggest thematic headwinds and those that have the biggest thematic tailwinds. So great response. I'm going to throw in a question here. It's been said that real estate is a great hedge for inflation. And you were in the brokerage world a lot. We talk about this, but real estate investors love throwing this out. Is that true? What do you think?
Yeah, so to answer that, I think thinking about longer term time horizons over cycles versus thinking about, short gyrations, right, that are going to be impacted by, interest rate moves and so forth. And so I think over the long term, as we think about real estate, it's clearly been an asset class that's had great performance. And, one of the best case studies you can see is that we saw inflationary growth like we haven't seen in 40 years over the last couple of years, and you saw commercial real estate, be a huge beneficiary of that. And to answer that question, I think if you've got shorter term lease durations, so using multifamily as a great example where you reset those rents every year on your tenants, then you can absolutely keep up with inflation, and I think take advantage of that. And other asset classes where you're going to have long lease durations in place, and you likely will fall behind of where inflation is going. And so, we're in a period now where we're starting to see some disinflation, which is just the slowing down or deceleration of inflation that will probably hang out somewhere in the 3, 4, 5% range, 3 to 4% range for some time, just due to the lag effects of some of the commodity pricing and owner's equivalent rent and so forth. And so we're probably going to be above the Fed's target, I think, which is 2% for the next couple of years.
And on that note, Chad, it's also said, a lot of real estate people that aren't economists like to, speak on economic analysis, but the cap rates and interest rates are not correlated. So what would you say to that?
I would say that they are correlated with a lag. And, what I mean by that is, I think it's, if you just step back and think, okay, if my cost of borrowing goes up, I simply can't afford to pay the same price over the long term. And so if you go back and study the cycles, I've done a lot of work on this, particularly paying attention to the early 90s and the Great Recession. You got to start asking yourself, why is the Fed hiking rates? And so they are hiking rates because we're seeing an overheated economy, right? So we're seeing very strong GDP growth, which is heavily, correlates very well with absorption, right? Because as we're seeing GDP growth, you're seeing business expansion, their revenues and profits are up, they're hiring new people, they're taking on new space, occupancy's down and rents are up. And so what actually happens is, during the phase of, if you look at the 90s and the Great Recession, while the Fed is hiking, we actually see cap rates compress into that because investor sentiment is at the peak, right? They are so bullish on the fundamentals that they're seeing, which is the very reason the Fed is hiking those interest rates. But then what you also see is the Fed pauses and they say, okay, we think we've tamed this growth, we've kind of brought it back under control. You typically see a flattening in the cap rate compression, and then it's when the Fed starts to cut is when you truly see the lift in the cap rate expansion. And so those are probably the two best times to go back and look at. If you throw a chart up of the Fed funds rate and CoStar market cap rates, is they are correlated but with a lag. And so when you see Jerome Powell say we're going to hike by 50 basis points, you're not going to see cap rates move by 50 points that day, that week, or even that year. But I think if you got to think about the full cycle and what causes the cap rate expansion, it's because the Fed hiked rates to slow the economy, and most of the time they do it too fast, too quick, and they break something, and then that's when you see that get triggered.
Okay. Great. Moving over to the questions that we have, Kenneth Dobbs asked the question, is it possible to adjust the chart for the influx of PPP funds and the impending impact on deposits? I believe that's the chart that you had. If you want to throw it up, I think it's very interesting. It shows the tracking of bank deposits, and you do see this spike during the PPP and in the COVID stimulus. So I do believe that is in there. I guess the question is, what would it look like if you were to take that out? Was that saving or those deposits increase purely a reflection of PPP? I mean, because it's obviously very hard to dice that out, but it's a very large number.
It's huge. It's a great question, and I don't have the number off the top of my head. But if you just try to, take a benchmark from 2008 and just kind of say, okay, where typically, were these deposits changing? I mean, we didn't see anything remotely similar to what we saw in 2020, right? And so I'm sure if you, which I can try to do, and if I can find that, I will send it to you and include it on the deck that gets distributed. I don't think we've seen anything like that run up in deposit inflows because of that time. So I don't have that number off the top of my head, but
Well, I mean, it
yeah,
is
that's a
interesting
great
because at
question.
first quarter of 2020, COVID was still very early, and I don't believe this, the stimulus program moves very quickly. But so, it is an interesting data point, Kenneth. I'd love to spend more time on that. I do know I connected with an economist yesterday. They mentioned 40% of the money supply was created in 2020 and 2021. So clearly that cash went somewhere. We have from Caden, Sarah, I'm a new college grad and want to become an expert in value add hospitality arena. Is there a good place to begin? Is a remodeling company a good place, or more on the debt and equity business, like RRA? Good question. I don't know if I'm the right guy. I would, you were a broker for 20 years. Do you want to take this one, Chad?
Yeah, if you could rephrase it, I got lost in the question.
Yeah, so there's a new college grad. He wants to get in value add hospitality. Where's the best place to start? Working in brokerage, working on the debt or equity side, working, construction. My thought, Caden, is, if you can work for a developer, that would be the best place. And I'd say second after that, probably a broker or a lender that lends on it.
Yeah, I would just add to it is I think real estate is an apprenticeship business. It's very hard to understand markets and what's going on just by simply reading about it. So I think you have to focus on who your mentors and who your teachers are, and I would prioritize that over income and salary, and realize that you're getting paid early on through education versus any salary. So place heavy emphasis on who you attach to and who you spend your time with.
Yeah, great feedback. So next question is from Elizabeth Witherspoon. Hello, Elizabeth. I'm glad you joined us. I think this one, Chad, is probably best suited for a lender to answer. But given interest rates are still historically low and seemingly likely to increase further, I think meant interest rates are still historically, well, maybe historically low is arguable, but likely to increase further. What do you see happening on the debt structuring side, terms, covenants, et cetera? I believe, interest rates are right now obviously higher than they've been in a while. And so it's very difficult for existing sponsors, particularly on refinance or even at today's values, because there hasn't been that cap rate expansion to really create some, valuations that allow investors to acquire assets and still generate sort of positive leverage on it. One thing that we're doing, and we're seeing, other groups do, is doing some sort of accrued interest that accrues on the back end of the loan. So you have a certain percentage current pay, and then a certain percentage that you receive when you get refinanced out. You also have some lenders creating, bifurcating the loan, doing an A piece for the senior, and then creating sort of a prep equity piece that sets on top of that, but it's sort of sold and quoted as one loan. And I do know too that our team, sometimes because so many borrowers are interest rate sensitive right now, maybe putting some points on the back of the loan that can still generate, hopefully, a more attractive yield for taking some of that back end risk, but also you're able to sort of help the borrower manage the debt service and the time being. So next question, this is from Jacob J. To what extent does the current market situation provide opportunity for buyers and investors, particularly in multifamily, for the next, let's say, 12 to 18 months? So Chad, would you say there's opportunities for multifamily investors in the next 12 to 18 months?
I'm sorry, I missed the question was cut out there. Was that broadly the question? Is there opportunity for multifamily investors?
Yeah, in the next 12 to 18 months.
Yeah, I think so. I think what's interesting is to try to find if we're seeing some sellers have assumable financing, which is an interesting way to still be able to pay competitive prices and to find opportunities. And I think looking at markets where there's good fundamentals relative to supply. Again, I keep going uh, back to that supply, and when we've got certain markets that are going to receive all-time high deliveries, we don't know how the market's going to respond to that, but it's generally not favorable for asset prices. And so that's I would say, yeah, there's absolutely, I think there's opportunity in all product types, but I think you have to be very targeted, much more so now than you were over the last couple of years.
Yeah, and I think just going back to one of the slides that you had, Chad, where you talked about most of the equity in the market has been raised for opportunistic and value add returns. So, that return profile wise on the growth side is really, 20, 25% plus gross returns. And then, on obviously the debt side, interest rates are really high. So in order to make sense of that expensive cost of capital, Jacob, you're going to need to see some liquidations. And I would assume that not too many current real estate owners want to take a hit, particularly if they don't have to. And this question's for you, Chad, just built on this, and I think we've got to close it up because we're getting on time. But during the S&L crisis, there was a Resolution Trust Corporation in the early 1990s, late 1980s, that basically forced the banks and taking the loans to liquidate their commercial real estate. However, during the Great Financial Crisis, what we saw was that the Federal Reserve really took a different approach, encouraging banks to keep that real estate on their books and extend and protect. So, if all that money's set aside for liquidations in order to get to a value that makes sense for an expensive cost of capital, do you think that lenders, if they have to take back these assets, are going to liquidate or they're going to extend? And I guess this is maybe beyond data, but you were a broker during the Great Financial Crisis, and you've got 25 years of experience in the industry. What are your thoughts? How does all that capital get put out if it's really targeting gross returns of 25% and higher?
Right. That's a great question. So again, the chart that you're seeing here, it's looking at billions of dry powder. I think that the number's something, if you add it all up across the different core plus, value add, and opportunistic, it's over 200 billion that's waiting there. And it's committed but not called. And I don't think all of that is going to get placed. I mean, some of it will just kind of lose there'll be a window of time where the capital didn't get placed. Lenders, from my experience when I was in the broker seat, is that when lenders would take the properties back, they would first try to add value. If you've got shareholders involved, I don't think they're of the mindset where they want to take these assets back and then just immediately turn and liquidate them. They're going to assess what they have. They're going to hire a team. They're going to probably go out and put new management and leasing on it to try to do anything that they can to create value before they look at a disposition. And so that just takes time. And this will, I think, be a slow process of lower transaction volume this year. And as lenders face some of these maturities and start taking properties back, there'll be still a continued period of time where they decide if they can add value. And at the point where they say, okay, we can't add any more value, we're going to cut with ties with this asset, then they'll dispose of it. And so all of that capital that's there, I think won't get placed. I think another thing that's going on too is you're seeing a lot of redemptions, right, at some of the private equity shops. So it's telling you that investors that have committed capital to the space want it back. And so that's where another component of this chart is people who've committed capital that's not yet called. Is that capital still going to be there if these funds call that capital? And so I think the next couple of years it'll be a kind of a slower unwind of these properties hitting the market from lenders.
Phenomenal. I think unfortunately we're at time. Chad, thank you so much for being so generous with your time, putting this together for our clients. And it's great to connect with somebody that, I haven't seen since the days of the great financial crisis. So I'm glad CoStar is very lucky to have you, and I'm glad they're taking an interest in this space.
Absolutely. Thank you. And it was a pleasure to be with you.
Great. Raphael, we'll get to your question. I think I'll try to email you on that. But thanks so much, everyone. Really appreciate it. Hope this was worth your while, and feel free to provide any comments or email us if you have any questions about commercial real estate markets, or bridge lending or debt funds. So thank you so much, everyone. Appreciate it.